Okay, welcome to the CEP study sessions. First, I would like to begin by presenting a disclaimer. So the material presented here was made for educational purposes and should not in any circumstances be taken as legal, tax, or any other type of professional advice. This is an independent initiative and has no relation to the Certified Equity Professional Institute, Santa Clara University, or any organization. Therefore, if any information presented here contradicts other material, please follow the official material as indicated by the CEPI. The main objective of this project is to bring awareness about stock plans, employee ownership, and help people from different backgrounds to enter this career. Although copying and sharing this content with others, given proper credit is encouraged, its commercial use is not allowed. I forgot to put it there. Sorry for that. So feel free to share it with anyone. There's no cost to it, and there will be no copyright claims as long as you give me the proper credit and you are not charging for this lessons or any part of this material. So I am Mateus Akawan. I am a CP. I abandoned a sales career in 2019 because I wanted to join the financial market. I was 25. I believed I was getting too old to get into that career. Until then, I had been working whatever would pay the bills. I already had a daughter, so I needed to pay the bills, and that was the most important thing. In 2019, I abandoned my job to start studying for financial certification in Brazil. I took that certification, I passed it, but COVID came, so I still was unemployed for some time until I joined Carta, and that's when I first heard about stock plan administration or even equity compensation. At that point, I got interested in the Certified Equity Professional exam. So 6 months after I joined Carta, I took my first exam in May. And after that, I took each exam every 6 months until I passed CEP level 3. So this is a very unknown career. That's one reason why I'm doing this. I think we need more people doing this. We need more people qualified to do this. And also, I believe this is a career that many people could get to know and could do it well as long as they take the time to specialize, to study. To be honest, just taking the exams, even if it is 1 through 3, will not make you entirely capable of doing stock plan administration yourself for a big company. I've been working with that for about a couple months, and I've had a great team, 2 great teams behind me teaching me all the steps, because to be honest, the daily practice is a lot different from what we study. But if you study this well, you get the knowledge that the Certified Equity Professional program can offer you. That will be a great thing for your career as a stock plan administrator. That will help you through lots of complicated issues you may encounter, and will certainly give you more assertiveness to deal with some issues on this profession. The reason for this prep course is not to make you a complete certified equity professional. It is to help people, especially those who have no knowledge in equity, to learn about this, to learn about equity compensation, and be able to aspire a career in this area. So in no way you're going to get out of this course able to do everything, but that's something that will help you decide if this is something you really want for your life, if that's a career you want to pursue, and also will assist you with the first exam. So one thing that I noticed when I first took when I started studying for the exam, is that everything that we're studying here is very specific. So we have things in other areas that do relate to it, but many things that we see in equity awards and equity compensation, they have its own swing to it. So having a specific material, really talking about it on the perspective of a stock plan administrator, was something that was missing the webinars that I found. Then they were not so detailed because mostly they were for people who already were in this profession. This is a program that was developed for people who already work in equity administration. So I wanted to do a prep course that will help my colleagues who had no previous experience with this area, to really learn from scratch. So the goal here is to help people who have no experience, no background, to learn all they need to know for the first exam, the Equity Compensation Associate exam. If you are one of these people, welcome. If you are an experienced professional, welcome as well. You may find that some things that I will present to you here are a bit obvious to you, who is already a seasoned professional. But still, as I mentioned, I'm really trying to go into details and things that will help people who don't know anything. So the difference from this prep course to the webinars that are made available by Santa Clara University and other webinars I found online is that we are not dealing with the sessions on a subject basis. So we're not breaking it into 4 sessions divided into taxation, equity design, accounting, and law, which are the 4 main subjects of the exam. What we're doing here is we're breaking it into 9 sessions. We're going to streamline everything. So whatever you are seeing on the second or the third session is something that you already learned the prerequisites to understand. So that's something I wanted to focus on this study program. And I think it's the main issue for people who don't have a background on this, because most of the times when you are watching the sessions that already existed in the internet, for you to understand something that was discussed in the in the middle of the equity design webinar, you would need to understand something that was mentioned in the first part of the law webinar. So I try to reduce that struggle and give you like a step by step of what you need to understand and learn here. So that should be the focus of our study session. So the first sessions will be very basic, but they are key to understand what we will be dealing with. So we're going to talk about equity awards, but before we talk about that, I want to talk about what equity is. And there is a curious fact that I got here for you. So the word equity derives from the Roman term equitas, which means justice. The current meaning of the word in the financial world is tied to its use in the 17th century by the British courts of equity. that were meant to enforce justice not by means of common law but equity, understanding equity as justice. And equity is a word that you will see repeated lots of times throughout these study sessions. And if you choose to join this career, you're also going to hear about this lots of times throughout your career. So it was then that the first joint stock companies came to existence. In this arrangement, managers held the assets on trust and issued certificates to investors. So this would be a predecessor of our companies, companies as we know them. So companies that offer stock, that offer equity. At that point, you didn't have a legal arrangement for that. But so what would happen is whoever the investors were, they would put the asset in the hands of a manager, and that manager legally would be the owner of whatever they were administering. But we understand that the investors, they had rights to that asset. And as common law did not have a provision for that, most cases that would go into normal courts, they would get into unfair resolutions. So the courts of equity, in the courts of equity, the judges, they had more liberty to interpret and give decisions that would seek justice rather than the common law itself. So at that point, they started to understand these rights that the investors had over an asset as equitable rights. So that's where the equity as ownership to part of a company came to be known that way. So you had equitable rights, and so while the manager had legal rights, the investors had equitable rights, and that's basically where the word came from. So when we are talking about equity in the financial world, generally we're talking about this ownership of a company, of an asset. So this part that you have in an asset that is not necessarily in your power, in your possession. Now, when we talk about equity awards, we are talking about a type of compensation, a type of award that is granted in equity, in stock, in ownership of a company. So you have regular compensation in currency, in money generally, and you have equity awards, which is a type of compensation that is given in equity, in stock. So this type of compensation is particularly common among tech companies, but is spreading across companies in all sectors. For some employees, stock compensation plans are not only welcome, but an expected part of their benefits package. So currently, especially in tech companies, the employees, they ask for equity. They want to have equity in the company. That means that they are owners of the company. But not only that, that means that they have potential gains that are huge. Because if you are joining a startup on its early stage and it's a successful startup, we know those stock will go higher and higher. I have seen people become millionaires. I've been on this for 2 years, about 2 years, and I have seen employees becoming millionaires just with stock. So there's a lot of potential of gains in this area, and many employees nowadays demand this type of compensation besides their regular benefits package, so salary, health insurance, and all of that. There are a few different types of equity awards to which there are different requisites to granting, issuing, expensing, and releasing the shares. Most companies have an equity incentive plan. Besides it being required by law or by exchange rules, this document should have clear instructions on the most relevant processes, rules, and guidelines that must be followed. So today we're going to talk about the equity awards. We're going to have a study session on this governing documents, the requisites, and all of that. But with this session, I want you to have a clear understanding of what each type of award is capable of and what are its advantages. We have a quick glossary here, which will be very, very important for you guys. Take a screenshot of that because you may need it at some point. These words, you will hear them a lot throughout this session and all other sessions. With time, they will become very natural because we'll repeat them all the time. But right now, if you want to take a screenshot, feel welcome to do so. Now we're gonna start with an option grant. What is an option grant? So basically, an option grant is the right to purchase stock from the issuing company at a future time by a pre-established price under predetermined conditions. So if you already know the derivative market, you already know call options, short options. If you follow the GameStop case, you may have heard these terms. So an option is the right of something. You have the option to do something at a future date. When we are talking about equity awards, we have option grants that are the option to purchase stock at a future date, which would be the equivalent to a call option in a market. You are not obligated to do so. Once you are granted the option grant, you decide if you will purchase the stock, the underlying stock, or not. That's an option you have. But if you do, you will contract some obligations and some rights as well. But first, we want to understand what the option grant is and what is important to evaluate about it. Now, we have the grant date, which is basically the date when the option grant is issued, is granted to someone. So that's the beginning of it. That's the origin of it, when the option grant is born. You have the vesting schedule, and this may be one of the hardest concepts for people who are not acquainted with this world to understand. But a vesting schedule is basically the determination of what is needed for you to actually have the right, the option to purchase such stock. Because when you are granted an option grant, that doesn't mean you can buy everything that's there. There are some prerequisites that you may be required to fulfill before. Most commonly, we use time vesting. So that means that you will have to stay with the company for some time to earn that. Now, imagine you have a salary. You are offered $100,000 salary throughout one whole year. And each month, you will get 1/12 of that. So that's what work arrangements generally are. You already have a notion of what will be your yearly salary. You will get part of it each month or semi-monthly. And if you just leave after 6 months, you won't get the whole yearly salary. You will get whatever you earned up to that point. So a vesting schedule is similar to that. We have different types of vesting schedules. The most common is the 4-year vesting schedule with 1-year cliff. And cliff is another important word for you to get in your head. So cliff basically means that there is a point from the grant date until the first vesting tranche that you won't get anything vested. Generally, most companies use a 1-year cliff. So let's imagine 4 years vesting with 1-year cliff. You have, let's say you have 48,000 options on your option grant, and you have 1-year cliff and 4 years vesting. So 1-year cliff and 4 years vesting. Okay. Now what will happen is when you get to that anniversary, those 12 months, at that point you will vest 25% of your grant. So you will vest altogether everything that you didn't vest in that whole year. So you had to stay for 1 full year until you got the first vested tranche, and when you get it, you will get it for every tranche that was not considered in these other months. After the cliff, you will monthly vest 1/48 of your grant. So in this case, what would happen is when you make an anniversary in a company, you will vest 12,000 shares, and every month after that, for the next 3 years, you will be vesting 1,000 shares. And from that point on, you have a monthly vesting. So this is what is most commonly used for employees, but we also have other types of vesting. We have vesting based on stock market price and other things, but we'll talk about that in a moment. Now, the exercise price is the price by which you have the right to purchase such stock. So if I have those 48,000 shares that will be vesting in 4 years with 1-year cliff, on the grant date, the value that the stock was valued at was $1. So if that was defined on the grant date, that's the price I will pay for the stock. So if in a year from now, the stock is now $10, I will be purchasing the same stock for $1. So that's the great potential that the option grant has, because you have the option to purchase the stock or not. If it is valued, then you will certainly purchase it. But let's say if this stock went from $1 to 10 cents, there's no reasonable reason for you to purchase such stock, and you can just decide to not exercise your right, and you won't be you won't have to pay anything. Now, the exercise price is set at the moment of the grant. It's one of the requisites to have a grant date. We will talk about what is necessary to define a grant date. It's not just something that you can arbitrarily say, but we'll talk about that at another moment. Now, the expiration date. So your option grant is not forever. It has an expiration date. Generally, 10 years is the time you have to exercise this option. But let's say if it was granted on January 1st of 22, you will have until January 1st of 32 or December 31st of 22 to exercise, depending if it is minus 1 day or not. But you may have 48,000 shares you can exercise, but from that date onwards, you will not be able to. That grant is no longer valid. It is null and void, and you have no rights over it. Okay, so under option grants, we have mostly two categories, two types. We have the non-qualified stock options. And if we have non-qualified stock options, also known as NSOs, it is clear that we have the qualified, I'm sorry for that, qualified stock options. So we can also call them NSOs, non-statutory options. And we'll start talking about the NSOs because they are simpler. So the advantages we have with the NSOs is that you have more flexibility upon issuance, more flexibility upon selling, because first of all, the company doesn't have to fulfill all the obligations they need to fulfill to issue non-qualified stock. If it was qualified stock, they would have to fulfill lots of criteria that goes from the way the plan is registered up to who they can issue to and how much can it cost. So NSOs are much simpler in that aspect. But the tax obligations are non-qualified, so you may pay more taxes when you are exercising NSOs than you would if you were exercising ISOs. So when you have NSOs, the tax obligations come upon the exercise of the option. So we talked about the option grant. It is granted. It has a vesting schedule. It can or cannot be exercised. So you have the option to exercise or not. But on NSOs, when you decide to exercise options, the company will have to withhold taxes. So at that point, when you exercise these options, the company will have to calculate what are your tax liabilities due to this exercise, and they will have to withhold that money to make sure that you can cover these tax obligations. I'm sorry, my cat is here and she decided she wanted to go back into the slide. Okay, so the tax obligations for the NSOs, they are calculated on the difference between the exercise price and the FMV at the moment of exercise. So I mentioned the market value, the fair market value of the option on the grant date, and you will get that same measure on the date of exercise. So if you have an option grant that was granted with an exercise price of $1, and when you exercise it, so when you actually purchase the stock, the stock is worth $10. That means that this $9 difference is taxed as ordinary income. So whatever is the valorization you get, this is spread that you get from the exercise price and the fair market value at the date of exercise is considered ordinary income. So it's just like if the company was paying you an extra salary, a bonus or something like that. And the difference between the FMV at the moment of exercise and the sale price is taxed as capital gains. So this part would be covered as just as any market transaction. So when you are selling your option grant, you will you will calculate the spread between what was your cost basis, what was the FMV at the moment of your purchase, and the FMV, how much you sold it for, and that spread will be considered capital gains or capital loss. We will go deeper into that in another session. This session is for you to understand the awards and not necessarily the tax treatments. Now, the difference of ISOs or incentive stock option, qualified stock options, is that it can only be granted to employees. So NSOs can be granted to contractors, can be granted to freelancers, independent workers, or whatever. Now, ISOs can only be granted to employees. There are lots of requirements for you to grant an ISO, which is one reason why plans also have the NSOs to cover those cases where the ISOs are not available. And although it is qualified, it can still be disqualified given certain conditions. One of them is the holding periods. So the great advantage of the ISO over NSOs is that you remember that ordinary income portion I mentioned. So the price, the exercise price, and the FMV at the moment of the exercise, that is ordinary income, that does not exist for ISOs. So whatever you are paying for on ISOs is capital gains. And that is an incentive because capital gains taxes are generally smaller than ordinary income. So technically you would pay less taxes if you were exercising and selling ISOs. However, to keep an ISO qualified in a qualified disposition, and by disposition we mean the sale of, basically you are disposing of the shares. So to have a qualified disposition, you have to hold the stock for at least 2 years after the grant date and 1 year from the exercise. So if it is granted on January 1st, 2020, you exercise it on May of 2020, and you dispose of it on June of 21, like, you are disqualified because you have to fulfill both of those. You have to fulfill the 2 years from grant and 1 year from exercise. The same would happen if you exercised in January of 25 and sold in July 25. Although you had fulfilled the holding period from the grant date, like, it's 5 years. You have not fulfilled the holding period from the exercise. Both need to be fulfilled. There are some other scenarios where this you will have a disqualifying disposition. Mostly if we are considering something to be a disposition, if it is a transaction that could be considered a disposition, even if you don't consider it so, that could be a disqualified disposition, but that's something for another session. When you exercise ISOs, you don't have tax withholdings, but you do have the company file a form 3921. So if you exercise an ISO in 22, in 23, at the beginning of 23, the company will have to file a form 3921. The form 3921 is important because that will have all the necessary information about your exercise in case you do go through a disqualified disposition. Because what happens when an ISO is disqualified is you will have to pay those ordinary income taxes. So at the moment of exercise, nothing is withheld. But if you do sell these shares within 1 year from the exercise, they will disqualify and you will have to pay the ordinary income taxes. And so that's basically it. The excess of the sales price over the exercise price is recognized as capital gains on the date of sale if it is qualified. So just remember, if you had an option grant at $1 exercise, at the date of exercise it was worth $10, and when you sell it it is worth 15, you will pay $14. You will recognize $14 of capital gains. This will not be ordinary income, and that should generally cause you to pay less taxes. Now, option grants have 4 types of exercise methods. As I mentioned, exercising means that you are exercising the right to purchase those shares. If you are purchasing those shares, if you are purchasing stock, you will have to pay for it. So there is the cash exercise, which is pretty straightforward. If you are exercising, you will wire the funds to the company, and that's it. You will pay for the options and you will get the shares. Pretty simple. Now you have the same day sale, which is basically you are purchasing the stock and selling it at the same day. So you are using let's say you have 100 shares that you can exercise. They are exercisable at $1, but on the market, these options are worth $10. Each share is worth $10. So you would have a balance of $9 per share. What you will do is you will give the order that you are exercising this to sell this at the same day. So if you have 100 shares and you are selling the 100 shares, what will happen is the 100 shares will be sold on $10 each. You will get $1,000, but part of this $1,000 was used to purchase the stock to begin with that had an exercise price of $1. So you have $100 that must be discounted. What you get is the balance of that transaction. You will get the $900. So the same day sale basically is an operation where you are purchasing the stock and selling it at the same day. You are only getting the balance. You don't touch stock. The stock is not transferred to you or anything because it is being sold at the same day. You just get the balance of that transaction. We have the sell to cover exercise. So basically, you are saying that you want to exercise the 100 options, but you don't want to pay for it. You don't have the money to pay for it. So the order that you are giving is that, okay, I want my stock to be sold up to the point it will be necessary to pay for my exercise. So if we are still on that example, and just for the purposes of example, I'm not counting tax withholding, I'm not counting brokerage fees or anything like that. So what will happen is if each share is worth $10 in the market, and I need $100 to exercise all of my shares, what will be done is 10 shares will be sold to cover for the exercise of those 10 shares. So what I get as the participant of the optionee is I get 90 shares. I don't get 100 because 10 of those were used to pay for the exercise. Now, we also have the stock swap. So stock swap is basically swapping stock. So you already have shares from that company, and you will tender the shares you already have as a manner to pay for the current exercise. So I'm exercising these 100 shares, and I already have shares from the company. So I have those 10 shares. I will give my 10 shares, and the company will give the 100 shares that I am now exercising. There is a reason for that to be important, but you don't need to focus on that until level 2 or 3. Just know that this exists. The stock swap exists. And it gets really complicated in the future. Okay. So this is basically it about option grants. We will talk about the taxation, about different scenarios in another study session. What I want you guys to understand from option grants is an option grant is the right to purchase stock at a given moment with a predetermined price, with predetermined conditions and predetermined dates and things that have been predetermined. So you can exercise this right, or you can just leave it be and not do anything with it. You don't have any obligations on this. Now, stock appreciation rights. This is where things start to get funny. So, one thing that happens with option grants is that they cause dilution. And what is dilution? Just imagine that you have a Kool-Aid. You have a little pack of Kool-Aid. So you serve this whole Kool-Aid in a glass without water. So now you have just Kool-Aid. You just have Kool-Aid. That's all you have, the Kool-Aid powder. If you put like 50 milliliters of water there, you will have a certain concentration. You'll have a highly concentrated juice because that Kool-Aid was made for a lot more than 50 milliliters. Now, if you put 100 milliliters in this Kool-Aid, you will still have the same amount of Kool-Aid. It's still the same exact amount. It's 100% Kool-Aid. But this 100% is diluted in more water. So just imagine that the Kool-Aid is the company, is the shares. Each powder thingy is a share of your company, and each drop of water is a person that is getting shares from your company. So the more water you put in this glass, the more it will be diluted. Now, the same thing happens with stock. So you have 100% of your company, and you decide to sell 20% for $10. Now you have 80%. Your company is still the same company. It can only be 100%. It won't be 110. It won't be 120. It can have more assets. It can have less assets. But 100% is 100%. It can only be diluted among other people. You can divide it into more shares. But if you have a company that has 1,000 shares, these 1,000 shares represent 100% of the company. If you have a company that has 1 million shares, those 1 million shares represent 100% of the company. And that's what dilution is. Because the 1,000 shares company has a lot less units to be diluted among other people than the one that has 1 million. So every time you are issuing stock to employees, you are giving up control over your company. You are giving up control, you are giving up ownership over your company. And that's not always what a company wants. So there is this balance between giving equity awards, giving equity compensation and employee ownership, and diluting your company more than you wanted to. Depending on the company, you want to keep the 51% under your control, either just with you or with you and family or you and a partner. But if you are issuing more stock, you are to different people, you are diluting your company and you are giving up control over your company. And you are bringing to your company more partners, more people that will have a say in your company, more people that will have a stake in your company. And that's where these alternative awards come into play, because they may help you provide stock-based compensation in a way without causing dilution. So let's talk about the stock appreciation rights. The name is self-explanatory. When we are talking about stock appreciation rights, we are granting someone the rights over the appreciation of a stock. So no stock is actually issued. So that means that there's no dilution to the company's stock. But it can be settled either in cash or stock. What the holder will receive is the difference between the exercise or settlement price and the stock price at the date of the exercise or settlement. Now, settlement and exercise should mean basically the same. You will see both terms interchangeably. There will be platforms that will call exercise. There will be platforms that will call settlement. So you should be paying attention to those and understand that the settlement is something similar to the exercise, in a way that you have that equity award, you have that award, and you are getting it settled. So your right is being fulfilled. Now, what you get in a stock appreciation right is the difference between the exercise price or the settlement price and the price at the date of exercise. So let's imagine that same scenario where we had an option grant that was worth $1 when it was granted and $10 at the moment of the exercise. If we bring this to a stock appreciation right, what we would have is those $9, that balance between the $1 from the grant date and the $10 from the exercise date. Those $9 would be the right the holder has. Now, this could either be settled in cash or stock. If it is settled in cash, it's pretty simple. We have 100 shares. The difference, the balance for each share is $9, so we get $900. Pretty simple, pretty straightforward. Now, if you have a stock settled SAR, that means that you will get $900 value in worth of stock. So if our stock is now worth $10, those $900, they must be given to the holder in stock. So basically 90 shares. That's the difference of the cash SAR and the stock settled SAR. Not very difficult. You should recognize those by CSAR or SAR. That's also a way that will be used to mention those. Now, um, some advantages to this is, besides the dilution, is no monetary contribution from the holder is required. It may be 409A exempt. And 409A is a rule that will set the value of these awards. We will talk about the 409A at another date, but when we are talking about 409A exempt, just understand that it doesn't need to follow some pricing rules that most awards do need to. Not only pricing, but mostly pricing. So, yeah, that's it. Ordinary income is recognized on the exercise date like NSOs. So they have a treatment that is similar to NSOs in that case. There are some accounting implications to it that we will discuss later. And now to sum it up, just like we did for the option grants, what I want you to understand about stock appreciation rights is that if you are the holder to a stock appreciation right, that means that you have the right over the appreciation of certain stock. You have the right over whatever is the price variance of the stock of whatever company you have over a period of time. Now, this exercise date, this settlement date could be predetermined and you will only have the option to exercise at that given date, or it could be voluntary, just like option grants are. This will depend on the terms of the agreement. But the thing is, you have the right to the appreciation and it can be settled in cash or stock. These are the stock appreciation rights. Now, phantom stock. We talked about dilution in the last slide. And once again, we have a way companies use to provide stock-based compensation without stock. So, phantom stocks, they are cash awards. No actual cash is issued, so no dilution to the company's stock. It is generally the right to a cash value in a set amount of shares. So you are granted 100 phantom stock. Generally, you don't have to pay any exercise. Actually, I've never seen one that you have to pay for any exercise. You are granted phantom stock, and it can have a predetermined date or not. But what happens is, when the phantom stock is exercised, you will get the cash value that those shares are worth at that moment. So that's it. It's not stock. It's not stock. It's just a way to give you compensation that is tied to the stock price of the company. That's an incentive. And it's common because one of the main objectives companies have with stock compensation, besides talent retention, is to nurture the ownership feeling. So they want the employees to know they have a say in a company. They want the employees to know that their performance affects themselves directly, that they are owners of the company, and if the company goes well, they will see the return of that. Now, the phantom stock can be full value or appreciation only. So in that case, it looks much like a stock appreciation right. Full value plans pays out the total value of the phantom stock. So it's the equivalent to real stock's value on the payout date. Appreciation only plans pays the excess of the current stock value over the value on the payout date. So yeah, much like a stock appreciation right. No monetary contribution from the holder is required. Settlement is at a pre-specified date, and ordinary income is recognized on the payout date, just like NSOs. Phantom stock is not stock. It's a way for companies to provide you value that is tied to the stock value. So that's what you need to get from the phantom stock, is that it is an alternative compensation method that will not issue stock, will not cause dilution, but will give you compensation that is tied to the price of a company's stock. Now we go into a more interesting part. We're going to talk about restricted stock awards. And that's the nightmare for people who are starting, because it gets a bit confusing. So to start, for starters, option grants are not shares. They represent the right to purchase shares. Stock appreciation rights, even if they are stock settled, they are not shares. They mean the right to get shares equivalent to a certain appreciation amount when you get to the settlement date. Restricted stock awards, they are shares from day one. When restricted stock awards are granted, you are being granted certificates of shares. So they are awarded or purchased at par value. So par value is the minimum price of a stock can have. So it's impossible for you to say that something has zero value, because that would be impossible. If there is an asset related to that, it should be worth something. It should be worth some work. It should be worth something. So par value is that minimum amount, which is generally 0, comma 0 at 0.00001 or something like that. So that's the minimum price a share can have. For most states, it is required to have a par value. A share can't be valued at less than the par value. So when you get a restricted stock award, you must either be paying par value, or the payment should be considered previous service. So you should be working with a company previously, and that previous service is the payment for this restricted stock award. So it can be awarded, but we will be considering, we will be requiring previous work. Now, once again, restricted stock awards, they are stock, but they are restricted. So when you get a restricted stock award, you get shares right off the bat. If you leave the company before the vesting is completed, or for some reason you don't vest, the company will repurchase it at cost. So it means that if it was at par value, then, well, that's it. And I've seen like thousands of shares in restricted awards total $1.38. So that would basically be it. It's really symbolic in a way, but yeah, they won't pay the full price of the stock to repurchase restricted stock awards that haven't vested. In general, when you get restricted stock awards, you have the same rights as regular stock. So you will have voting rights, you will have dividend rights, you will have everything that a stock owner would have, even though this is an award. One thing that can be done is filing an 83B election. That's an option for restricted stock awards. And that's important to say because it's different from its counterpart, which we'll mention in a second. And what are 83B elections? So remember that when we were talking about option grants, we talked about the ordinary income that is measured from the exercise price and the date of exercise. We are talking about a startup that granted awards at $1, and we are seeing exercises at $10. So that's a huge difference. And those $9 will be all ordinary income if you have non-qualified options. Restricted stock awards, they are not qualified. So the same thing that you have for those NSOs, you have for this restricted stock award, which is 83B election, which is basically you telling the IRS that you don't want to pay taxes later. You want to pay taxes now. So on an NSO, you have to do it. On an NSO, you have to do it when you are exercising. And we will explain why that is and what's the difference for that in another session. But for RSAs, what you should understand right now is when you get an RSA, when you are granted an RSA, you are getting shares. So you are being granted shares. You won't recognize taxes for that now because they haven't vested. They are still subject to a substantial risk of forfeiture. They could be forfeited, they could be canceled, you could lose the right to this stock. So you will not pay taxes at this moment, but you may choose to. And that's 83B election. And why people choose to do that? Because it is a lot more advantageous if you are getting shares, if you are getting RSAs at a current value of $1 per share. It is better to pay ordinary income for $1 that you are getting rather than $10 in the future. The bad part is this is not refundable. If you lose this stock, you will just lose it. You won't see it again, and you just pay taxes when you didn't need to. But if you are assuming that you will stay with the company for a long time, if you are assuming that this stock should increase in value in the near future, that's advantageous. You should pursue an 83B election. And we will talk more about 83Bs, and when we do, we'll explain how it works on NSOs. But what you need to understand on RSAs right now is you are granted shares, but you do not pay taxes on these shares right now. You only pay the taxes when they are vested. Now we have another friend, the restricted stock units. And to be honest, this was my terror because I would always confuse those two and their differences. But after some time, you start to understand the logic behind it. And that's why this is one of the most important sessions that we'll have. Actually, the 3 first sessions, they are very important because they lay the foundations, they lay the logic behind the equity awards, how they work, what are the intentions behind them. And this will help you understand what are the consequences, what happens in this or that scenario. Because if you understand the framework, it is a lot easier to understand what is the tax consequences, what are the legal consequences to these different things, because you already understand the logic behind it. Now, restricted stock units, they are not stock from the beginning. That's the main difference between stock units and restricted stock awards. Actually, RSUs, depending on how what's the grant agreement, they may even not be paid out. They may even not be settled in stock. They can be settled in cash. So that's the first difference. You don't get shares right away. You don't own shares when you get RSUs. You own the right to shares or to a cash settlement based on the price of shares in a future date. So this is important for us to talk about release, and that's an interesting concept on RSUs, because just as we do have the exercise for option grants and we have the vesting, for RSUs we have the vesting and we have the release, and they may not be synchronous. So in general they are, because you are not paying anything for basically anything for the restricted stock unit besides the tax withholdings. So generally the release is automatic, but if you elect to defer your units, they will be released at another date. So just as 83B is making an election to pay taxes now, the section 83I, which is the one that rules the deferral for these RSUs, it will allow you to pay taxes later. But when you choose to defer, the release of the shares will also happen at a later date. So you won't have shares, if we're talking about a stock-based, a stock-settled RSU, you won't get those shares until the release is made. Now, besides that, the unvested units are not eligible for voting nor dividend rights, but they may receive dividend equivalents, and the ordinary income is recognized at release. So the timeline of a restricted stock unit or an RSU is you have the grant, which is when the terms are determined, the initial date when the RSU is born. You have the vesting, which is the fulfillment of the conditions to earn these units. And you have the release, when the shares are granted to you, actual shares are issued and given to you. Now, this release could happen at the vesting date, or it could happen at a deferred date if an election to do so is made. Now, this box here, it shows the differences between restricted stock awards. This is one of your greatest friends in the exam, because you may not remember this during the exam. So it's on the GPS book I forgot, but on the restricted stock part of the book, around page 30, I guess. There's another box that's very useful, but it's on the GPS book, so you can see the books during the exam. So that's where that is. Actually, most of the relevant information regarding restricted stock awards and restricted stock units, be that taxation, accounting, treatment, it's mostly at that book, the GPS. So knowing that will save you a lot of time. Now, here we have the possible underlying rights that that will cover these awards, and we have a comparison between restricted stock units and awards. So the issuance of shares for restricted stock awards happen at grant, and for units at release. And remember, this release is when the shares are issued, and it can be and will generally be the vesting date. But if there is a deferral election, it could be a later date. So release does not necessarily mean vesting, but generally it does. Automatically it does. If there is a deferral election, it's a later date. If there isn't a deferral election, business as usual, release happens at the vesting date. Voting rights, restricted stock awards generally have voting rights. This will mostly depend. This will also depend on the share classes that are being granted and other provisions and preferences of the share classes, and also the provisions that the plan will have. Restricted stock units, they can't have voting rights. They don't have shares. When the shares are released, so they are vested, they are released and issued, those shares that have been released, they are no longer part of the RSU. The RSU is only what hasn't been released, and what has not been released is not shares, therefore no voting rights. About dividends, it does not have dividend rights. It can't have dividend rights because those are not shares. But it could have dividend equivalent rights, which is a provision that will foresee that whatever regular stock, common stock, or preferred, whatever is the share class, is getting as dividends, the RSU will get in dividend equivalent, and that amount will be generally paid out to the holder when the shares are released. So when the shares are released, they will get the dividend equivalents from the time they were vesting, but no dividends. If there is a question asking if restricted stock units can receive dividends, no dividends, only dividend equivalents. Tax obligations, so RSAs will have tax obligations at vest and restricted stock units at release. And once again, that's generally vesting, but not always. And I'm stressing this very much because this is something that if you understand that restricted stock awards are shares and restricted stock units are not, and just when they are released, they become shares, then you get to see the difference between these two. And most of these questions or these answers that are on this box, you can just assume them. You will, once you understand the difference between these two awards, this will become a lot easier. So that's why I'm stressing so much that restricted stock units are not shares. Restricted stock awards are shares from the beginning. So when you are vesting, you are paying the tax obligations because you are no longer subject to substantial risk of forfeiture. That could also happen to RSUs, but I don't want to confuse you now. So what I want to understand you to understand is the tax obligations come at release, and release is generally the vesting date, but not necessarily. You will probably get questions on this. So yeah. Okay. Now, when we talk about the restricted stock, we have tax obligations. And as I mentioned, for restricted stock awards, they are at vest, and for RSUs, they are at release. And well, we have three different methods. We have cash, which is the simpler one. Employee will pay cash in order to pay for the tax obligations. So the cash source comes from the employee. That's a method that's generally available for every plan. There is the sell to cover. It is available on public companies because if a company is a private company, it can't, and shares aren't traded in the public market, you probably won't have anyone to sell these shares to cover for. But in any case, sell to cover, basically part of the shares that would be released to you or that are being vested are sold in order to pay for your tax obligations. And the money to pay the taxes, because the IRS is not taking payments in stock yet, I think so. The funds to cover these tax obligations are provided by the transaction, and a broker is required because the stock has to be negotiated, has to be traded for that amount to be generated. And there is the withhold to cover. So sell to cover, there is a selling transaction. Withhold to cover, the company is withholding shares. So what happens in this is that the company should, like, you are vesting 100 RSAs and you should pay $50 in taxes. That's how much the company should withhold from you. Each share is worth $10, so the company will issue to you, let you stay with, depending on if it's an RSA on RSU. So from the 100 shares, you will get 95 shares. And 5 shares will be used to cover the expense. This is not always available, although it is preventing dilution. There's a bad side to it, which is the company has to pay the tax obligations. So if they do this for everyone, it's a big company, just imagine that they will keep the shares, but they will have to get money out of their pockets to pay for the tax obligations. So that's one reason not all companies choose to do that. And there's no broker required because it's the company that's withholding the funds. Now, performance awards. Oh, performance awards. They are whatever we talked about in this last slides with a twist. They are based on performance. And when we talk about performance awards, talking about it broadly, we have vesting conditions that are based on market performance or goals that are different from time. Like you don't have to just stay with the company. You have to stay with the company, but the stock should be traded at $20 for at least 30 days, or your department should meet a selling goal, or if you are on a pharmaceutical company, a new patent, a new medication has to be approved. So in general, we will be talking about awards that are based in goals that are not time based. We don't need to talk much about this because in general we won't see much about this on the first level, except uh, there are a few exceptions, but most of them will be covered throughout the next sessions. Uh, Basically, we won't talk much about this for equity plan design, but we will talk about this for accounting purposes mainly. Um, so we'll talk about it at another session, and I hope you liked this so far. Please let me know if it should be more interactive, if there's something I should put in, or well, whatever feedback you guys have. As I mentioned, these this study program was developed for my coworkers. Um, the company was offering a benefit for people who would apply for the CEP exam. So right after I took my exam, lots of people wanted to take the exam because they had just approved this incentive. So at that point, there were lots of people who knew nothing about equity administration or just the basic, because we were in a company that basically worked with it. Um, and I wanted to provide a material that would allow them to learn about equity compensation and really take the exam with confidence, take the exam really knowing the material, not just guessing things or trying to understand it just on the surface. I really wanted to lay a strong foundation for my colleagues, and I thought this material was necessary for that. So I may go into some extra details for whoever is watching this and is more experienced, but this is because I really want people that have no experience, that had no contact with equity administration, to watch this and I don't know if get interested. Um, if there is a stock plan administrator here watching this, like we know this is not the funniest professional, not uh, the most adventurous market, uh, but it is cool. We get to see different things. We get to understand a bit of um, law, a bit of accounting, a bit of everything. It opens so many doors to interesting things. And yeah, if you are new to this, I just hope you enjoy it. Hope this is not so boring to you. And if it is, let me know. I will try to put on some other memes or other things here. I do want you guys' feedback. So my LinkedIn is here. My Instagram is here. Feel free to DM me. If you have questions, feel free to send me an email as well. Um, I'll be pleased to answer you guys. Really, this is something that I really enjoy doing. So don't feel ashamed of asking anything. Don't feel ashamed of sending a message with a feedback, something you didn't like, or I don't know, whatever. Send me a message if you have any feedback or anything. I will read everything. you send, there aren't those that many people interested in this. So it won't take that much of my time, not more than it takes to prepare these sessions. So feel free to contact me. Really, 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 that's very nice to me. At this point, I can say that this 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 area, this market, this career changed my perspectives a lot. And in so little time, I was able to grow so much. And every day I work with it, I'm learning so much more. It's amazing. And I would love to share this as an opportunity to people who don't know what they want to do, but they are generalists, people who want to know a little bit about everything. And if you are one of these people, if you are detail oriented, this is for you. This is for you. If you take the time to study this and study Excel, of course, this you may end up having fun. I do have fun on this. Most nights I'm crazy. Like I'm recording this, it's 20 to 5 a.m. because after work I had to take some time to watch the Warriors game, and until I could really record the session. Like most nights you will be crazed out, but you learn so much. It is a lot of fun. And if you don't know what to do and you are detail oriented and you didn't sleep through this session, stay around and watch the other sessions. Maybe there's something for you here. Okay, so these are my contacts. Contact me on LinkedIn or Instagram, email. If you are a company admin and you don't know how to administer your stock plan, your stock in general, and you are looking to learn a little more and do that yourself, or you could use some help, here are my professional contacts as well. As I mentioned, I work with two amazing teams. One for Carta clients and one for other platforms. And funny thing about this one is I got to work and learn from a teacher we have on the materials that are available in the internet. Like one of the funniest teachers we had on the webinars is now my boss and is teaching me directly. It's also a field that you will get to know lots of people and learn that everyone knows each other. I don't know everyone yet, but I've noticed that already. And I'll stop talking about the area. I like it. If you like it too, like feel free to talk to me if you want to know how that is as well. It doesn't need to be a question regarding the session or anything like that. If you want to know how it is to work with that, well, let me know. I'm available. So see you around. And how do I stop this? Oh, here it is.